Pretend we're going to a New Year's Eve party. And before we go, we check the balance in our ATM, and our ATM says pick a number, $10,000. Okay. So after you're at the party, you're dancing a little bit, you're having a good time, and the ball falls. 5, 4, 3, 2, 1. Happy New Year, right? And for whatever reason, you run outside, you go to the nearest ATM, you check your account balance, and what's it going to say? $10,000. Just because we're in a new calendar year doesn't mean that your money all goes away. Think about it like this. Pretend we're going to the New Year's Eve party again, right? Let's just say you owe, pick a number, $400,000 on your house, right? You go to the party, you dance a little bit, the ball falls, 5, 4, 3, 2, 1. For whatever reason, you log online to see how much you owe on your house, and what's the number going to be? $400,000. Okay? The balance in the permanent accounts, whatever the ending balance is at the end of the period, will be the beginning balance for the next period. The amount does not go away. Your other two permanent accounts are going to be your capital stock and your retained earnings. Now notice capital stock and retained earnings are part of the equity group, correct? But remember that equity group is the renegade group, right? So not all equity accounts act the same way. The only permanent accounts in the equity group is going to be capital stock and retained earnings. Okay? If you look again very closely or think about these accounts, these are also the accounts that are reported on the balance sheet. So any account reported on the balance sheet is going to be a permanent account. Why don't you update your notes on that? Now let's talk about our temporary accounts, okay? Your temporary accounts are your revenues and expenses. So basically, what we're going to do is we're going to close those accounts, right? We're going to close those accounts at the end of the fiscal year. What does it mean to close an account? That means to bring the account balance to zero. Well, how would we do that? Well, if revenues have a credit balance and we want that account to say zero, then what must we do to that account? We must debit it to make it zero because debits and credits are never added together. If expenses have a debit balance, how would we make those accounts zero? We must credit them because again, debits and credits are never added together. Income summary. Let's make some notes about this. This is a new account. This is a new equity account, okay? And it's different than the other equity accounts because this one has a normal zero balance. Zero, Z-E-R-O, a normal zero balance. That equity group, I tell you, they write their own rules, all right? Now, the income summary account is only used in our closing entries. It's used on the first 3 closing entries, which I'll illustrate to you in a second, okay? Income summary is never reported on any financial statement. So again, let's recap income summary. It's an equity account. It has a normal zero balance. It's only used in the first 3 closing entries, and it is not reported on any financial statement. At the end of the first 3 closing entries, it should have a zero balance. It starts off with the zero balance. It ends with the zero balance. Therefore, it's not reported on any financial statements. Your last temporary account is your dividends, okay? Is your dividends. Now let's look at these accounts, the temporary accounts. These accounts are all the accounts that are going to be listed on our statement of retained earnings, which means they move into retained earnings. Revenues minus expenses gives us our net income or net loss, which got put into the got reported on the statement of retained earnings, less our dividends, which gave us our ending retained earnings. So our closing entries are going to take these amounts and move them into the statement of retained earnings. Now, if you would go back into your textbook and looking at Exhibit 2, if you go back and find the adjusted trial balance that related to Exhibit 2, that company was Net Solutions. Okay, find that. Put me on pause while you find that. And then what I'm showing you is Exhibit 5. So if you would go and find the adjusted trial balance for Net Solutions, I'm going to, if you compare that to what I'm showing you on the screen here, Exhibit 5, which is in your textbook. And because I'm using the electronic textbook, I can't give you a page number, but this is going to be under the closing entries, I believe it is, if you look under that objective. Okay, so what we're going to do is first close our revenues. So remember, revenues have a normal credit balance, so we must debit them to close them. You have 4 closing entries. Please write this down. Your first closing entry is going to close our revenues. So we're going to list our revenues, and this is always going to be the last day of the fiscal year. So we're writing this in our journal. So you have the last day of the fiscal year. Yes. Oh, goodness. This is live streaming at its best, yes? So you have the last day of the fiscal year. You're going to list your revenue accounts. You should have nothing in the post reference column at this point because we haven't posted yet, okay? So you're going to list your revenues, and you're going to credit income summary for the total. So you're only going to credit income summary one time. You're going to do one entry for all of the revenues. Does that make sense? Okay. Then our second closing entry, please write this down, is to close our expenses, okay? So we're going to debit income summary because to close the expense, you would need to credit them. So you're going to list each one of your expense accounts. Again, you're going to list each one separately. You're going to total that up, and that's going to be your debit to income summary, okay? Now, after the first 2 closing entries, think about what's in your income summary account. You have a credit balance equal to the revenues and a debit balance equal to the expenses. Debits and credits are never added together. So if you subtract the revenues from the expenses, the balance in the income summary account is going to be equal to the net income or net loss. Go back to the financial statements that I showed you on the previous exhibit. The difference between these 2 amounts is the net income or net loss. Closing entry number 3, we close income summary to retained earnings. Please note what I just said. Closing entry number 3, we close income summary to retained earnings. We never close retained earnings. Remember, we talked about previously, retained earnings is a permanent account, okay? So if we have a net income, that means we have a credit balance in income summary after the first 2 closing entries. So we're going to debit income summary for $1,105, and we're going to credit retained earnings for the same amount. How do you increase retained earnings? By crediting it. What does net income do to retained earnings? Increase it. So again, your closing entry number 3 is going to be a debit to income summary and a credit to retained earnings if you have a net income. If you have a net loss, it's going to be the opposite. It's going to be reversed. It's going to be a debit to retained earnings and a credit to income summary equal to the amount of the net loss. Let me say that again. If you have a net loss, what does a net loss do to retained earnings? It decreases it. How do you decrease retained earnings? By debiting it. So if you have a net loss, you're going to debit retained earnings and credit income summary. And if you had a net loss, this amount here, total expenses, would be higher than this amount here. So to close income summary, we would need to credit it. Does that make sense? Take a second to update your notes. Repeat that section if you need to. Our last closing entry, we close dividends to retained earnings. Okay? Again, we close dividend to retained earnings. So what you're going to do is dividends always decreases retained earnings. So you're going to debit retained earnings, credit dividends for the amount of the balance in the dividends account. Again, dividends is a temporary account. Retained earnings is a permanent account. So you're never going to use the balance in the retained earnings account. You're always going to use the balance in income summary and dividends in your closing entries. Okay? At this point, the only accounts that will have a balance will be your permanent accounts. And we will use those accounts to prepare our post-closing trial balance. So now I'm showing you Exhibit 7, the post-closing trial balance and net solutions. Again, you can turn in your textbook to find these pages, okay? Now, the post-closing trial balance has the same 3-line heading that we've come to know and love. And remember, we're going to prepare the post-closing trial balance after we record the closing entries to the general journal, post them to the general ledger. And this is to make sure that we've posted correctly, so then we prepare a post-closing trial balance. Okay? The only accounts that have balances, let's see if I can clear this up now.